There's different types of stablecoin yield per se, right? So there's stablecoin interest, right, based on the lending and credit markets. So you'll be unsecured creditor to a platform that will take your assets and loan, just like a bank, loan to other participants of the market and pay you an interest, right? Can be variable, can be fixed. The duration can be day or a month or a year. So there's one market like that. So credit markets, they do provide yield in stablecoins, similar to what banks do. Another participation market is DeFi. So let's say there are protocols that need liquidity. So those protocols will also facilitate some kind of a function, right? Either trading, either lending, either settlement payment. But you'll be on the one side of a transaction providing the liquidity into the pool, into the protocol, and you'll get part of the fees generated of that protocol paid back to you. So you can think about it as a, I don't know, invoice financing or short-term short-term loans as well, right? When you provide your liquidity to a pool, but you are in control of that liquidity, you can pull it back at any time. So your risk is primarily not sending the funds to a counterparty. You still own the funds because it's on the blockchain. You can pull it back at any time, but the counterparty itself that can get hacked, can get pulled, can get rug pulled. So there's still counterparty risk in that sense, but it's different type of yield. So DeFi yield that will be paid to you as part of the portion of the revenue that that counterparty generates. And then the third one is trading. So you can be using a bot on your Binance account, or you can be using a trader or hedge fund, and they will be doing market making or arbitrage. So some kind of a market making on the exchanges, right? So that's also another way to generate returns on your stable coins in today's market. So there's a credit market that generates interest. There is a DeFi market that generates yield as part is pro rata of the revenue of that protocol, and there's trading. So
And like, why is this yield infrastructure becoming an important layer with the digital asset ecosystem? And I mean that in relation to there's been a lot of, I guess, media on the banks not liking this yield stuff. So maybe you could talk a little bit about that.
yeah, I think listen, there's a few things. I mean, you can one thing the banks do very similar what some of the platforms do, like Kraken, Coinbase, as an example. I'm not really familiar with the mechanics, but the idea is that you are a depositor to a platform that's centralized. They use your deposits to generate returns, and they pay you a portion of that. So banks have been doing that for forever, right? Plus, they're able to do it on a fractional basis, so they can leverage 10 times on your deposit. While, let's say, stablecoin regulation doesn't allow you to have fractional reserves, you have to be one-to-one backed, or the stable coins, at least with some liquid kind of instrument as T-bill or money market has to be behind it. So you take a dollar from a depositor, you put it in a T-bill, you take a dollar from a depositor, you put it in the money market. So on your balance sheet, you have one-to-one equivalent, right, of the deposits that you hold. Bank can leverage up, right, 10 times on every deposit. So it's very different and in the sense of money creation. But in terms of the mechanics that funds are used to generate profit for a bank or for that centralized counterparty, it's very similar. And I don't think banks are afraid. It's just not clear the regulation. I mean, when those centralized platforms fall into the banking regulation or not, if they start doing that type of a business. I don't think banks are afraid of losing all the deposits. There's too much capital, trillions of dollars that are held by baby boomers and older people that are not really familiar what is a stablecoin. They don't even know that word. When you say circle, they think about the circle, right? They don't think about the company behind USD, right? So it's I think it's exaggerated the fear from the banks, right? It just I think more like regulatory wise, if you're doing what banks do, right? Why you're not a bank? Why you're regulated differently? So plus, I think overall on the regulation side, that this administration is doing a good job. I mean, things are moving forward. They're moving slower than anticipated, but they're moving compared to what was done on the last administration, at least in the U.S.